In this video, we will understand what is call debit spread, when we will create a call debit spread, what are the different ways we can create a call debit spread, and its advantages and the disadvantages. First, before we understand the call debit spread, we have to understand what is meant by a spread. Spread means it involves a multiple legs. In case of call debit spread, here you can see I bought a one leg and I sold another leg. That means it involves the two legs. That is why it is called as a spread. And it is called as a debit spread. Why it is called as a debit spread? Because we pay money from our pocket. That's why it is called as a debit spread. Now we understood what is meant by a spread and what is meant by a debit spread. Let's understand how to create the call debit spread. To create call debit spread, we buy one leg and we sell the another leg. The buy leg will be which is close to at the money or in the money, and the sell leg will be out of the money. To understand the call debit spread, we are using a Nifty as an example. Nifty is currently trading around 24,050. In this example, what we did is that we bought one lot of call and we sold one lot of call. So the call strike which we bought is 23,950. That is in the money call. That is called as a ITM. ITM means in the money call. And we sold one lot, that is 24,150. That is OTM. This is out of the money call. I already mentioned like we can create the debit spread in a multiple ways. In this example, we are using in the money and out of the money. In another example, we will see how to create using ATM and OTM strikes. Before we understand the different types of debit spread and their differences, first we need to understand the advantages of creating a debit spread. For example, if your assumption about the market will move up, what you will do if you are an option trader, you buy a call. Okay, so the disadvantages of the buying call is that if the market doesn't move, if the market stays where it is now, then you will lose the money. For example, instead of creating a debit spread, I will remove this sell leg. Okay, here you can see we only bought 23,950 call. In this case, what will happen? Maximum loss in this particular trade, you can see 5,500. This is the maximum loss when I buy directly a call without creating a debit spread. And the secondary thing is that if the market doesn't move up as we anticipated, if the market stays where it is now, so here you can see in the orange box, we'll lose around 3,500 rupees in this particular trade. We are losing only 3,500 rupees because we bought in the money. If you have bought at the money or out of the money, you would have lost entire thing. Whatever the capital we paid to buy the call option, right? We will lose that. Secondary very important point is the break even. Break even over here is 24,171. That means the market has to move up around 130 points. Currently Nifty is trading around 24,030 plus. Okay. So that means market has to move 130, 140 points, then only I will be in a profit. If the market doesn't move, imagine the 4th July, it expires around the same price what it is currently trading around. Currently trading around 24,030 plus. Okay, so if it expires over here, then you can see in the orange box how much money we will lose. We will lose 3,500 something. Okay. When we buy a naked call option, if the market doesn't move, if market stays where it is, then we will lose some money. Okay. That means when you buy a call option, the market has to move significantly upside, then only you make a profit. In this example, market has to move around 130, 140 points in a given time. The given time means when is the expiry? That is on the 4th July. That means 4 to 5 days to go. Okay. So before that, if the market moves about 24,171 and if it expires above that particular point, then only you will make a profit or else you will lose the money. Now let us switch back to the debit spread. So if I switch back to the debit spread, then what will happen? Here we can see directly the maximum loss is there, right? It has come down from 5,500 something to 2,600. That is 50% reduction in our maximum loss. Okay. Maximum profit in this particular trade is that 2,300. So this is the disadvantages of the debit spread. In naked call, what will happen? You will get an unlimited profit depending upon the market movement, but the market has to move significantly upside to make a profit. If the market doesn't move, then we will lose huge chunk of the money. But in this example, in debit spread, you can see if the market doesn't move up or move down, okay, if it stays where it is now, clearly you can see we are not making any losses. In the orange box, you can see what is the loss we're going to get. Only 49 rupees we will lose at the end of the expiry if the market stays where it is now. So this is the advantages of the debit spread. If you buy in the money call and sell OTM, right, what will happen, right? If the market doesn't move upside also, if it stays where it is, then the loss we incur, right, very small. We won't lose the entire thing. Whatever the maximum loss it is showing, right, we won't lose that much. That maximum loss happens only if the market expires below this particular strike. What is the buy strike? 23,950. If the market comes down and expires over here, that is 23,950 or below, then only we will have this maximum loss, or else we won't incur this maximum loss. And whereas the market has to move around only 20 points. Here you can see the break even, it is 24,057. What it is previously when I bought a call, it was 24,171. That means the market has to move up significantly to make a profit when you buy a naked call. Whereas in case of the debit spread, market doesn't have to move up much. Okay, if it moves around 20-30 points also, you won't get any loss. If it moves like let's say if the sell leg is there, right, that is sold leg is 24,150. If the market expires around 24,150 on July 4th, okay, you will get this maximum profit. So these are the advantages of creating a debit spread. Let us summarize the difference between the debit spread and naked option buying. In debit spread, you can see the maximum loss is 2,600. If you are a naked option buyer, what is the maximum loss? Maximum loss we can see over here is 5,500 rupees. That means the maximum loss in case of the debit spread is smaller. Second advantage is the break even. Break even in case of the debit spread, we can see 24,057. If you are a naked option buyer, the break even will be 24,171. That means the market has to expire above 24,171 to make any profit in naked option buying. In case of our debit spread, the break even is 24,057. That means the market doesn't have to move that much upside to make a profit. Okay. In this particular example, what we have done is that we selected a in the money call option for buying purpose. We sold OTM call. This is the OTM. Okay. The sell leg is OTM and the bought leg is in the money. That is also called as a ITM. So if you don't know the difference between in the money, at the money and out of the money, I have done an exclusive video on that particular thing. I will share it in the description. You can watch it. Now let us create the debit spread using a at the money and out of the money option, and we will see the difference between this particular debit spread and the at the money and out of the money debit spread. In this example, we created a debit spread using at the money call option and out of the money call options. In this example, you can see 24,100 call, which is very close to at the money. We bought it and we sold 24,300. The distance between the buy leg and the sell leg is 200 points. So you might be wondering, do we need to maintain always 200 points difference? No, it's not like that. You can maintain a 100 point difference or 150 points difference or even 300 point difference. It is up to you. For our example, I have selected 200 point difference. Okay. Here the key differences between the in the money debit spread and at the money debit spread is that the maximum profit. The maximum profit over here is 3,000, whereas in case of in the money debit spread, the maximum profit is around 2,300 something. Okay, and the maximum loss over here is 1,900, whereas in case of in the money debit spread, it is 2,600. Okay, here the better risk reward is there compared to in the money debit spread. But the catch is here the break even. The break even, you can see it is 24,177. Whereas in case of in the money debit spread, what is the break even? It is approximately 24,057. Okay, that means the market has to move up only 20 points to get into the profit zone. Whereas in case of at the money and out of the money debit spread, the market has to expire above 24,177. When is the expiry? That is 4th July. 4th July, if the market is about 24,177, then only you will be in the profit, or else you will be in the loss. The striking difference when comes to in the money and at the money debit spread is that in case of at the money debit spread, you can see if the market doesn't move up, okay, market remains where it is now, then also we will lose the money. So what is the maximum loss? We lose 1,900 over here. Whereas in case of in the money debit spread, if the market doesn't move up, if the market stays where it is now, for example 24,047, then what is the loss we are going to get? It is only 249 rupees. We won't lose the entire amount which we paid. Okay, so what is the maximum loss over here? 2,674. We won't lose 2,674. We will lose only 200 rupees. So this is very important. Okay, probability of profit in the money debit spread is high compared to at the money or out of the money. Of course, the risk reward is better in at the money and out of the money, but the market has to move up significantly, then only you will make a profit. Whereas in case of in the money debit spread, so market doesn't have to move up much to get into the profit zone. So this is the striking difference between the in the money debit spread and at the money debit spread. You have to create a debit spread depending upon your market assumption. If your assumption is the market might go up, but you are not sure it can go up significantly, then you go for the in the money debit spread. If you are sure that market might go up significantly higher, then you can go for at the money and out of the money debit spread, or else you can go for both out of the money buy and out of the money sell. Okay, so it depends on your assumption about the market, how far the market can go up. Okay, let us summarize what we learned so far. The first thing is that we learned what is debit spread, when we create it, and how to create it. The secondary thing is that difference between the debit spread and naked option buying. What are the advantages of the debit spread over the naked option buying? And we also learned different types of debit spread, in the money debit spread and at the money debit spread. What are their advantages and the disadvantages, when to use what. I hope this video is helpful to you. Thanks for watching.